Welcome to the Commercial Real Estate Report. Today we're talking about the state of self-storage and where it's headed here in the near future. I'm your host, Chris Berg, head of business development and land acquisition in California for Abernathy Holdings. We build Class A self-storage sites in California and Arizona. So if you have any land you want to sell, we are definitely in the market to make some aggressive offers and continue to build more sites. Got a great guest with us today. Before I introduce him, I want to give you a little rundown on his background. Very impressive. He's the Senior Managing Director of Investments and Executive Director of the Self-Storage Division with Marcus and Millichap with the LeClaire-Schlosser Group. Over the last 10 years, completed over 150 self-storage transactions, done over $2 billion in volume. I went to The Ohio State University. I think maybe most importantly, served our great nation with the Army National Guard, Aviation Black Hawk Battalion, Adam Schlosser. Adam, welcome to the show. It's great to have you. And again, thank you so much for your service to our great nation.
Thanks for having me, Chris.
So let's start there. Some of your background. I'd love to hear how you ended up getting into CRE and, of course, how and why the self-storage asset class.
Yeah, so it's been about almost 20 years now. So been through a few cycles here. Originally started out in the Columbus, Ohio office after I got back from deployment. Started out as a brand new broker, freshly minted, ready to take over the world in 05. And if you can remember, the 05 and 06 market was a very frothy time, kind of like what we had just come off of over these last couple of years. So, new guy trying to break in. I was in the multifamily space, just pounding the phone like a new young broker should there, getting minimal success out there, but nonetheless was working away, and through that met a friend and a partner out there and said, hey, what do you think about this self-storage space? And I really hadn't thought a whole lot about it. I think most people that have been in this space for any amount of time, if you've been in certainly as long as I have, most of us got in by accident there. It wasn't something that we kind of either woke up and said, hey, I want to be in self-storage. It certainly wasn't something I was leading at the when I was single out at the bar and leading with, hey, I'm in the self-storage space. That's not the the way that I was going there. But I've been making all those calls, and we said, hey, let's try this self-storage thing here. We think it's catching on. It's an emerging type niche product. Maybe let's see what we can do. There weren't a whole lot of brokers in it. And one of the first calls we made, we asked the question, hey, have you thought about selling? And the guy said yes. And I've been hearing no over and over and over again for 8-9 months. I didn't even know what to say when the guy said yes. So I said, okay, I'll be over, and ended up meeting him and doing a deal. And then it kind of grew and it grew. And before we knew it, we were now specializing in the self-storage product type. They're full time, and one of the things that's interesting is rates at the time. The 10-year Fed funds rate were right about the same size or rate as with it that they are today, but the difference is that we were coming off 8% money, going into 6-7% money, as opposed to now we were coming off 3% money and going into 6.5-7% money. And obviously, there's a big difference there. So, we'll see what the end of this cycle brings. We're still active out there. The self-storage space continues to hold its own. And I think one thing that's important to remember is what brought this space into, made it accredited or wanted people to get into that, investors and Wall Street to get into it. And it was trying times. It was adversity. It was the great financial crisis that really brought this niche into a mainstream market here. Because if you remember, the stock market crashed, the residential real estate was in big time trouble. But there was one little product type on Wall Street that was going like this or holding steady when everything else was going like this, and that was the self-storage space. So institutional capital. Certainly the REITs that were already in the space, private equity saw that, and they said, this is a place that we want to be. And it really, from that point forward, it really changed everything in the space. there, from the way that we manage, from the way that we evaluate these stores, and it was all for the better. And I got to ride up a fledgling industry that turned into the behemoth that it is today, and I've benefited very greatly. So I said, better be lucky than good. I was certainly lucky back then to be in this space.
And good as well. If you've done $2 billion in volume, I think we can classify that as good too. It's so funny when you
it's actually 7 billion now. I think that was over the last year and a half was the 2 billion number.
Wow. Okay. I just pulled it, I think, from your bio or the website. So 7 billion.
Somewhere there. But we've been on an amazing run over the last couple of years here. So those numbers have really shot in a meaningful way.
So let's talk about that, because I feel, I was at the SSA, Self-Storage Association event in Vegas, the national one, and many people are saying, hey, look, like you said, it was frothy, right? I mean, it was COVID times. We may never see that again, but things are kind of normalized. So what's your assessment based on comparing where things were and where they are today?
I think normalized is the key phrase in what you just said. We got to remember that we came off 2 extraordinary years driven by COVID. There created additional demand in a way that we've never seen. Monetary policy was all derived off COVID, dropping interest rates to where they were, and we experienced this massive boom in our space. And we had never seen values jump the way that they had. So fast forward, today we're kind of coming off that party, if you will. We're in a little bit of a hangover stage right now, I'll call it. But we are normalizing back to where we were prior to that run up. I mean, we've taken essentially 5 years of lease up, or well, you can call it lease up, but rent growth, revenue growth, and compacted it into 2 years. There, it just was not sustainable. I mean, if you look at our publicly traded REITs, they were anywhere from 20 to 25% year over year revenue growth. So not sustainable. So what we're doing now, we're just slowing down here, and the talk on the street now, if you're out there, is where kind of rents and occupancies are. We plateaued around 97, 98% during the height. Traditionally, we had been around 90% occupancy, 92. When we started dropping down on the occupancy side, the operators, especially at the top, were trying to hold the line on the occupancy. And to do that, they're dropping rates there. So some of the headlines, some of the negative headlines out there, well, street rates dropped 20, 30%. While that is happening, we are still in a healthy place as an industry, because if you think about 20, 30% drop, and you would look at it, let's just take our top companies. You would think that there would be a decline in revenue at the end of this year. It would be catastrophic. Well, I think what you're going to see at the end of the year, you're going to see a 6 to 8% revenue growth across the industry there, and that is bolstered by management practice. So we basically adopted a airline ticket model, a hotel type model, where it's based on demand. So when occupancy starts to drop, the more sophisticated operators in our space will lower rates in order to get that tenant in. The tenant thinks they're going to be in for 2 to 3 months to get these introductory rate, and they say, well, when the rate burns off, or when they raise the rents on me, I'll just move out. Well, we find they're a lot stickier than that. The people in our industry know that, very sophisticated. So we're dropping rates down, and then within 2 to 3 months, we're starting to revenue manage or ECRI them up, existing customer rental increase, and they're getting the revenue back that way. So what appears on the surface may not always be what's actually happening in that store. And I think that's probably the toughest thing that we're dealing with now, certainly on the evaluation side of the business.
I was just going to ask, that was another big talking point at the SSA in Vegas, was the fact that you've got these very low rates publicly for strictly a customer acquisition piece. And then once they get in the door, like we had a site in Glendale, for example, and through some different resources and whatnot, we knew the public facing rate, but boy, you got in the door and it was much, much higher. So I want to get your thoughts on that and what people are doing to lower the public facing rates so much, just from a customer acquisition standpoint, but also then how do you educate your banker? Right. Because he
Yeah.
just sees those public rates. He's like, hey, man, I can't underwrite it at this. And you're like, no, 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 no. Once I get him in the door, it's going from 230 to 300 or whatever.
Yeah, I think the lending side is certainly has its own issues. I mean, nobody puckers up quicker than the lenders when you start to get to the end of a cycle. They constrict and they're very risk averse. But luckily for us, we have a lot of sophisticated capital in our space that has deep relationships with their lenders, most of which have done many deals with these groups. So the educational side, that certainly helps, that relationship that they have. Some are better than others, but it's still a challenge. I mean, even if you've been in this space for 20, 30 years, this is still a pretty new practice. I mean, this started about 10 years ago, just doing this, and in a rising tide, all ships, this works very well. Moving dynamic pricing rates and working tenants up, and you can really maximize there. Well, when you have pressures the other way, you have to kind of look at your model and say, okay, how do we make this work in the context of a declining market? Here we got a little bit of taste of it during the supply that happened over the last 5 years. There we had pressure on rates and we were kind of moving them around, but we're still as an industry working through how to best do this. But look, our job as brokers is to try to educate and present the assets in the best possible light that we can back up. And it has been a bit of a challenge, doing that, because if you look across at your comp set, for example, you're going to see low rates in there. The issue is you can't get in and look at those rent rolls there. That's not public knowledge there. All the thing that's public knowledge is those street rates. So we've paid a lot of attention to in-place rent rolls, dissecting those rent rolls, showing what the ECRIs have done. Are the tenants sticky? That certainly helped. And then giving context, of where these marketplaces were prior to, this rundown in rates and where they could potentially get back to. But sometimes it works great, and sometimes it doesn't. The more risk that continues to be priced in, the more uncertainty. Buyer pool, lender will typically go, if they don't see line of sight, they'll typically go to the kind of the more conservative side of things if you can't present them with enough data to get them to see otherwise.
So with where rates are at, obviously what's been happening with banks as of late, more difficult to underwrite deals. So who are the main buyers that you're talking to right now that are showing the most interest in the space?
Yeah, so the top end of the food chain, the institutions and the REITs, they are very selective in what they're buying today. They're one of the more risk averse subsets, more food groups. They don't have to take risk out in the marketplace, and they are coming in anecdotally and buying deals that fit into their business plan, their geographic footprint. There's been a few mega deals that have happened recently with the acquisition of Life by Extra Space, and then the acquisition of Blackstone simply by Public there. So, but outside of that, the buyer pool today is very much private equity, which has always been the largest subset of the buyer pool there. If you look at the number of private equity funds in that space there, it's massive. There are billions of dollars trying to get in the space on that side. But I think they see an opportunity now with the institutions and the REITs sidelined in a sense to get in and try to win more deals. So they are certainly the most active out there. But I mean, look, they gotta get these yields to fit into their buy box as well. So that can be a little tough today with the market a little disjointed right now.
I mean, for us as a developer, we get excited, right? Because I think even in your guys' 2H23 report, it talked about the amount of construction was equal to what took place in 2016. We see with rates and access to money that development probably slowing down a bit. So we figure, hey, 3-4 years from now, we're going to be sitting pretty because you're going to have still the same demand, but a lot less supply. Do you concur with that? Or
no, I agree with that. I do think a lot of developers have backed off just with fundamentals in the space, with rates artificially kind of down there with construction cost, way up here, and land cost still continues to hold. I think better than we all thought at this time. It's really dropped a lot of those deals out of the market. They're just not penciling right now, especially if you're putting, if you're levering up with market rate debt. Very challenging. But there is a subset of developer out there that is kind of swimming against the grain. I think they're going to be rewarded greatly for it. That are saying, look, we know times are tough, development's tough, the market's tough, but we see opportunity in that. We're going to keep our heads down. We're going to plow forward. Most of these groups are capitalized in a little bit different way that allows them to do that. And, as we continue to roll through and work through whatever we're going to be working through over the next couple of years, you're going to see development drop off even more. And then once we get back to a normalized economy, those developers that stayed the course, I think, are going to be rewarded greatly with not a whole lot of supply to impede their lease up. So I think the groups that can do it, I applaud them greatly.
Thank you for confirming our thesis. That was nice to hear. I want to get your take on this. So also at SSA, Robert Kaplan, he's the former president of the Dallas Fed. He spoke, and one of the things I asked him about, and I want to get your take on, is just where rates are at right now. And so according to Redfin, 82%, and I guess I should preface this, our business is so much built on people moving. And so right now you've got 82% of homeowners with a mortgage 5% or lower, 62%, 4% or lower, 23.5%, 3% or lower. There's not a lot of incentive to move.
Right.
So do you think people just become sort of normalized to these higher rates and they start to move? Or do you think these people are just stuck thanks to the Fed and we're not going to see movement for quite some time?
I mean, I think, if the rates stay where they are, I think it could be some time before you start to see an efficient residential cycle start to emerge again. I mean, I do strongly believe that there is so much pent up demand already built up on that side. And if we first of all, we just need rates in a certain sense to just level off. Yeah. I think that's going to have a big effect, really on the psyche of the marketplace, but just more line of sight of where these rates are going to be, and that will allow some of those institutional players, some of those groups around the sidelines, come back into the market now that they can model more efficiently. But I think rates eventually are going to start coming down. I mean, I do believe that over the next, let's call it 18 months, I do believe we're going to go through some type of economic issue here. I don't believe it's going to be a soft landing. I think it's going to be a little bit more than that. And I think it's going to induce the Fed to start to lower rates, because we do need to start things going again here. And that will, if they just start dropping down a little bit, I think it'll kind of break the ice out there. But hey, I mean, it's hard to let go of a 3% mortgage when you're borrowing at 7%. But I think that will matriculate through. I mean, you think of, pricing on the residential side, if interest rates stay high, where stocks and businesses are valued today based on cheap money. Basically all the assets across, the different subsects are all priced on that 3%, 4% money. And if it stays up there too long, there's going to have to be a meaningful correction to get things back in balance. And I'm hoping we won't have to go through a deep one to get there. But I do think that something is going to happen where those rates are going to start dropping, hopefully in the Q3, Q4 of next year. And once that does, it's going to open up a lot. I think the residential marketplace could see one of the largest booms we've ever seen in this country, because there's so much pent up demand and there's so little supply still.
And what's going to be fascinating to watch, because you just mentioned Q3, Q4 for rates start to go down. Let's remember, we're in the middle of an election year, right? And the Fed does not want to look like they're putting a finger on any weights there. So it's going to be really fascinating to watch Jerome Powell sort of thread that needle. And, I don't envy that situation at all. You brought up, you want to comment on that at all? Or
No, I think that as well.
But you brought up a piece about, hey, where you think things potentially could be going. And we know some of the refis that are coming in the commercial space. Corey Sylvester from DXD Capital recently tweeted out where he suggested, and I haven't seen the data than from him, but over 60% of the self-storage loans in 2024 are going to have a DSCR of less than 1. What does that mean for the future of self-storage, in your opinion?
Yeah, I mean, it's certainly something that we've started to deal with more and more over the last couple quarters. Those phone calls have started to ramp up. We don't have distress in a true sense in our space yet. I mean, maybe by missing payments and foreclosure and those types of things. We do have this impending kind of debt issue where your takeout debt was supposed to be somewhere around 4 to 5, and now it's around 7.5. And you have projects that didn't go perfect from the operational side, so you're missing your debt covers there, and I think it's going to fuel transaction velocity. I mean, there are going to be groups out there that are going to have to sell because of it. I think you're going to have a good subset of those that are going to be extended down the line, but you're also going to have a subset of those that has to do something. And we have a number of deals out there right now. What's really saving us on that side was while the deals didn't go perfect, most of these loans were put on in 19 and 20. They're now coming due in 3 to 5 year cycles, and some even earlier than that at 18. So that 18 to 2021 project that was in the middle of that massive construction boom there. I think a lot of those numbers are in what the reference was earlier, where those properties were constructed. I mean, you could build a Class A multi-story deal back in 18 and 19 for around 120 a foot net rentable. Today, that same store is going to cost you somewhere around 170 to 190, let's call it. So we have this delta between what it could be built back then and where it can be reproduced now. And even though the economics don't feel the best to the buyer pool, they can look at it and say, hey, I don't love where it is right now, but I can't reproduce it for any less than 180. So there's this happy medium between the two, where the developer's still getting out and making a little money, and the buyers coming in and getting what they believe to be a pretty good deal here based on the basis, and we're getting those transactions done because of that.
Thank you for saying that. 'Cause I'll share with you and everyone watching, as we have been focused strictly on development, and because of we believe is coming down the pipeline as far as some of this DSCR situation of loans, we're now starting to open up our buy box to acquisition, C of O, and so just keep us in mind. All right.
Yeah, for sure. There'll be opportunities, no doubt.
So you guys recently put out that 2H 2023 report on self-storage. You're doing a lot of conversations with people across the country. What do you see as maybe where are we headed, and what are some of the hotter markets to focus on?
Well, I get asked a fair amount where the best markets are today, and there's pockets in many markets out there. If you remember, this is a 3 to 5 mile radius business, very different from multifamily or a lot of these other product types here. So you can find good submarkets, micro markets in a lot of the top 100 MSAs out there, and even further out than that, the secondary and tertiary markets. There's certainly areas out there, but on the just to answer your question more broadly, I think I focus on the marketplaces that have delivered early in the cycle here. So you have, and what I mean by that is Denver, for example, my backyard. Denver got just hit very hard in 18, 19, and 20 with new construction. I mean, we increased our supply 33% in there. And we're not unique. I think maybe we're a little bit more than maybe some other markets out there. But there's a tremendous opportunity to add new supply into our space here based on some of the metrics that were already in it. And there wasn't a whole lot built in Denver over the last 10 years. So it was kind of a fertile ground here to build. And that's exactly what they did. But it all came all at once. And we had our issues. We had absorption issues. We had rates drop down. COVID was actually a blessing in that regard, because it pulled us out of that with the extra demand. And now we have very little new construction on the docket here in Denver. So I would focus on the markets that had delivered early in the cycle. Here, there are other markets that have delivered late in the cycle. So a lot of markets that it didn't take it as hard in 1890, but it's taking it later, and it's taking it now, and that's going to weigh on fundamentals in those types of markets. So I look to that. I mean, there's aren't too many things that can really be a thorn or kryptonite to self-storage there. But the number one thing is supply. They can really throw a wrench into it. Outside of that, it holds its own pretty well. So I would say focus on the markets that delivered early.
So I want to be respectful of your time. We put certain time frame on this for you to so I just want to give you a chance. Anything else you want to share, and just give you the last word?
No, I'm just very thankful to be in this space. The self-storage industry as a whole isn't going anywhere. I mean, we're going to go through, our trials and tribulations, just like everybody else out in the marketplace. But I think we're going to prove once again, like we did in the Great Recession back in 8 and 9 and then 2010, that this is a place where investors' money should be. It weathered the storm then. It's going to weather whatever storm is coming. And we're going to look pretty good coming out the backside.
Adam Schlosser, $7 billion in volume with Marcus and Millichap. Thank you so much for your time. I really enjoyed this, and I appreciate your insight.
Yeah, appreciate it, Chris.